Brad Williams, Frugal Finance. Look, I'm going to go through another example of old school versus modern. I say old school, confusing engineering approach to future value because, again, I'm using another source. The author is Agee, and this is his technique back in the 60s and the 70s. Why am I introducing this? Because it's old school. And old school is not bad school. It's just how it was done before we had Excel. That's not a bad thing. AI ain't going to do it. It won't do it. It doesn't have the logic to figure out math. It will look at this. All it will do is scrape the information. It will look in its database, and if it finds something and an explanation, it'll spit out an explanation. It'll explain it, but it won't solve it. So don't for a second think that AI is going to do any help here. So with that being said, you can read in here, what are we trying to do? Consider the example depicted in figure 3.1 in which an individual deposits $1,000 in a savings account that paid interest at annual compounding rate of 8% for the first 3 years, 10% for the next 4 years, and 12% for the next 2 years. Note how the cash flow diagram down here, wherever it is, right here, has been modified to incorporate the notation of changing interest rates. How much money was in the fund at the end of the 9th year? Unless you do this all the time, you're going to have to sit there and go, well, what's the logic? Well, a map always helps. You do something like this, it helps. But this right here, okay, one, you won't have access to this data here. You can calculate it, but it's just the future value table. I've shown you how to do this, but this will be for a certain period, and then we have this other period, and then we have this other period. So it looks like we have $1,000 for the first 3 years, and then we're going to have to take this $1,259, and we're going to have to change the rate, and then we have to change it again. You can see how incrementally we have to do this. Sort of a pain in the ass. So here we have this new approach. Well, I personally like to just do this. I like to make a map, and I like to try to decipher this information and put it so I can visually see what's going on. So the first year we have the $1,000. It's at 8%. You got 8% and it's growing there. Then it grows again. Then it goes to $1,259. 61. Well, this has to change. So you can see that I changed this in year 4 to $1,259. Then I changed the interest rate. Then we have to do this again, and then we have to go over. And you can see I just changed these numbers here. All I did was take this 1080, and then it grows to 1080 at 8% to 116. Then I just took 1166, 1259, 2313. There's the bottom line numbers, 2313. And it's so much easier. You could see the flow. You can see where interest rates change, and you can just do the compounding. I just do this for myself. Doesn't mean anything. I just look at the future value. It's 1355. If you look at this, if you just look at the future value, it's 1313. So you have $10,573.45 earning 12% annually, 1% per month. What was the original deposit? Here you have, in very simple terms, we're just using Excel. We've done this a million times. It comes out to 9383, and you can reverse this, okay? That's exactly what we did. If you deposit 9383, what is the future value of the 9383 at 12% compounded monthly? We're just flipping it over. Future value, notice we have present value, and then we have future value. Isn't that amazing? All we're doing is flipping it over. So 10573. Isn't that the same number we started with right here? What is the compounded monthly interest rate? Well, we've done this. We go way back. Should be session 4 where I showed you all those examples. All we're taking is this 9983, using the rate function to come up with this 1%. Notice, be careful here, the periods, number of periods. Usually we would put 1 there for 1 year, but it's 12. Come up with 1. What is the interest rate compounded monthly if you deposit 93 and enter? We're going to have a number of periods. We've gone through this repeatedly. Just remember what we're trying to do here. We're looking at rate, payment, present value, future value. We know we're not looking at payment. We know we have a present value of that 938. We have a future value, 10573. This is just practice, practice, practice. This is the math as opposed to Excel. Put it here so you understand what we're trying to do. You don't need to be married to Excel. You can do this old school way. Here is another example. You deposit the 300, earning 12%, 1%, and then this is just after year one, 3843. So D69, have some D69, D80, 3843. This is just $300 deposited monthly, earning 12%. Here's the amount after year one. Here's the amount after year two. Moving on, extending this consideration of changing interest rates to series of cash flows. The present value series of cash flows can be represented as, again, we have this hard to read formula. I'll say it's really hard to read because it's really hard to read. It's the same stuff we've been seeing time and time and time again. Then we have this even more difficult formula. This is just the present value, and the same thing up here. I didn't explain it that well. We've got the future value here, and then we have the present value here. Same thing down here. All we're doing is computing some hypothetical, and the hypothetical will be some cash flow. Consider the cash flow in 3.2. Determine the present value, future value, and uniform equivalents for the cash flow series, computing the present value. So we have cash flows. We got 200, minus 200, 300, 200, 200. Interest rate at 10%, 10%, 8%, 8%, 12%. You could do it this way. Kind of hard to do. You could see that it's just the layout to get to this bottom line number. This is what we're shooting for, is this number right here, this 589. Sometimes this stuff is hard to decipher. Maybe you just go, Williams, it's so much easier to do it this way. Again, if you're the controller for a particular company, yeah, you're going to want to do it this way. But this is not for you. This is an introductory course for those that shy away from present value and future value. This is how you break it down. You're going to see what we're trying to do, looking at cash flows, future value, in order to derive at bottom line number. In the end, we have $200, 261, 362, 0, 287, come up with 58901. Why? I will allow you to scratch your head, do what I do. I work it out. So you got to figure out what you're trying to do. You have a present value of 372.60 right here. Why? Future value 589.01. Why? I'm not going to give you the answer. I want you to figure it out. Brad Williams, Frugal Finance. Thanks for watching.